Welcome to TalkTickers. Today we're diving into the recent earnings call for BrightSpring Health Services. They're a pretty big player in home and community-based healthcare.
Yeah, and it looks like a strong start to 2025 for them.
Definitely. The short version is revenues were way up, mostly thanks to their pharmacy solutions side. We're going to unpack that.
Absolutely. So total company revenue hit $2.9 billion. That's a hefty 26% increase from last year.
26%. Okay.
And their adjusted EBITDA, that also saw a nice jump, 28%, landing at $131 million.
And margins looked better too.
Yeah, importantly, their EBITDA margins actually improved during the quarter. So good signs on profitability.
Okay, so let's get into the specifics then. It sounds like, different bits of the business contributed differently. Where did the real push come from?
Well, the pharmacy solution segment was really the standout. That brought in $2.5 billion in revenue.
Okay, the lion's share.
Pretty much. And that's up 28% year over year.
Wow.
Within that, you've got two main parts, Specialty and Infusion Pharmacy, and then their home and community pharmacy. Both did well.
How well?
Specialty and Infusion saw remarkable growth, actually, up 33%.
33%? Okay, that really jumps out. What's behind that?
A lot of it seems to be these limited distribution drugs, LDDs. They're managing 127 of them now.
Right.
And they expect to add another, 16 to 18 or so in the next year and a half.
So that's a strategic focus.
Seems like it.
Yeah.
These are often complex, maybe higher margin drugs. Plus, they mentioned gaining market share because of, good service quality. And they're also pushing generics where possible. That whole combination seems to be working. Specialty script volume alone was up 32%.
Okay, impressive. And the other pharmacy piece, home and community, that wasn't quite as high, but still strong.
Yeah, still solid. That grew 14%. Primarily just more prescriptions filled, more customers coming on board. And they see more room to grow there too, like in assisted living, behavioral health, hospice, those areas. At home pharmacy as well.
Makes sense. So pharmacy is clearly firing on all cylinders. What about the other big piece, provider services?
Provider services also showed positive momentum. Revenue up 12%, hit $346 million.
12%.
And the adjusted EBITDA for provider services grew 9% to $51 million. That gives them a pretty healthy margin, 14.8%.
And wasn't there something about fewer days in the quarter this year?
That's a good point, yeah. Q1 2025 had fewer calendar days because 2024 was a leap year. So that 12% growth is maybe even a bit better than it looks on the surface.
Right. Context is key. So drilling down into provider services, where did they see the most strength?
Home health care is the big chunk there, about half the provider revenue. That includes home health, hospice, primary care. That whole area grew 21%.
21. Okay.
Yeah, their average daily census in home health and hospice was up 12%, over 30,000 patients.
What's driving that?
It seems like good operations, strong quality scores, patient satisfaction is high. They've also opened new locations, de novos, and landed more Medicare Advantage contracts.
Yeah.
And they specifically called out home-based primary care as a big growth opportunity going forward.
Interesting. What about the other parts of provider?
Rehab care, that's maybe 20% of the revenue, grew about 5%. Yeah. They added some neuro rehab facilities, new programs like Rehab in Motion, contracts for seniors and assisted living.
Okay.
And then personal care, that's the remaining 30% roughly. That delivered steady growth, about 3%. With a small increase in the number of people served. So
really positive across the board, it sounds like. Pharmacy booming, provider services showing solid, maybe even understated growth because of the calendar.
Exactly. And this strong start, well, it's clearly boosted their confidence for the rest of 25.
How so? Did they update guidance?
They did. They raised their full year 2025 guidance for both revenue and adjusted EBITDA. Now, this excludes that community living business they're selling off. Important note. But yeah, the adjusted EBITDA guidance is up $25 million at both the low and high end of their previous range.
That's a pretty confident move, raising it by $25 million.
It suggests they feel good about how things are tracking, definitely.
And speaking of that community living business divestiture, any updates on the timing?
Yeah, they still expect that to close in the second half of 2025. It's pending regulatory approvals right now. The FCC, Federal Communications Commission, is reviewing it.
Got it. So the numbers we're talking about are basically the ongoing business.
Correct. Community living is now treated as discontinued operations in their financials.
Okay. In healthcare, there are always these, external clouds on the horizon. Did they talk about potential pharma tariffs or the Inflation Reduction Act?
They did touch on those. For tariffs, they don't really see a major hit in 2025, mostly because of contracts they already have in place, inventory levels, that sort of thing.
But maybe longer term.
They're keeping an eye on 2026 dynamics, yes. They also mentioned about half their drug supply comes from the U.S. and North America. And for generics, there are competitive sourcing options.
Okay. And the IRA.
They think the impact will be manageable, something they plan to offset through, growth and just running the business efficiently.
Makes sense. What about Medicaid exposure? That comes up a lot.
Right. So after they sell the community living part, Medicaid will be about 10% of their revenue.
Just 10%.
Yeah. And importantly, the patients they serve through Medicaid are mainly seniors and people with complex needs. Historically, that group hasn't been the main focus of funding debates and has typically seen rate increases each year.
So maybe less volatile than some other areas of Medicaid?
That seems to be the view, yes.
It also sounded like they're focusing internally on efficiency, procurement, lean operations.
That's right. They expect those efforts to help improve margins, starting as soon as Q2, actually.
Okay. And how's the cash flow looking? Because growth is great, but cash is king.
Very true. Cash flow from operations was strong in Q1, $102 million. And they expect to deliver over $300 million for the full year on a run rate basis.
And they're using that cash.
A key focus is paying down debt, reducing leverage. They're aiming for a leverage ratio of 3.0 times this year after the divestiture cash comes in.
Right. The proceeds from that sale will help.
Exactly. They expect around $715 million in net cash from that. Long term, they want that leverage down to maybe 2.0 to 2.5 times.
Okay, clear deleveraging path. Did they mention interest rates? Always a factor.
Yep, they extended their interest rate hedge out through September 2026 just to manage that risk. They figure quarterly interest expense will be around $43 million.
Okay. And one last area innovation. They mentioned things like bundled services, value-based care.
Yeah, they're pushing forward there.
Yeah.
Especially in primary care. Their ACO, Accountable Care Organization program, is currently upside only.
Meaning no risk if they don't hit targets.
Exactly. No penalties, just potential bonuses for savings and quality. They sound pretty optimistic about hitting double-digit savings rates there eventually.
Which could mean real money down the line.
Potentially significant EBITDA contribution, yeah, as they get more patients enrolled. They also have their own managed care plan, INIP, that they think can grow in multiple states.
Interesting. Did they comment at all on that potential deal involving the medicines company assets from United Health? Any overlap or opportunity?
They were cautious, mentioned confidentiality agreements, which is standard.
Sure.
But they highlighted their own quality metrics and platform strength, sort of positioning themselves as, a potentially positive player in those discussions.
Yeah.
They said there's minimal geographical overlap with those specific locations.
So maybe an opportunity, but nothing concrete.
Exactly. And it all depends on the main United acquisition closing anyway. Their general M&A approach, they said, is focused on smaller, tuck-in deals that make sense financially and don't mess up their leverage goals.
Okay, that makes sense. All right, so that's a pretty thorough look at BrightSpring's Q1. Impressive pharmacy growth, solid provider performance, raised guidance, focus on efficiency and debt reduction.
And those value-based care initiatives simmering in the background.
Exactly. Okay, let's shift gears. It's time for our This Is Not Financial Advice segment. Based on all that, what's an outrageous but plausible trade idea you've cooked up?
All right, so given that really strong growth in specialty pharmacy, the 33% driven by those LDDs and market share, here's a thought.
Okay.
How about going long BrightSpring, BTSG, while maybe taking a short position against a basket or ETF of, say, traditional established pharmaceutical manufacturers, the big guys without that heavy specialty focus?
Interesting. What's the rationale there?
Well, the idea is that BrightSpring's niche in high-growth specialty pharmacy, especially these LDDs, could allow it to outperform the broader, maybe more mature traditional drug sector. It's basically a bet on the growing importance and profitability of specialized pharmacy services.
A bet on the niche player outperforming the giants in their specific area. Okay, I see it. Plausible, definitely outrageous. Got another one.
Sure. Thinking about the provider side, and their emphasis on home and community care being lower cost, preferred by patients, plus their progress in value-based care, like the ACOs.
Right, the shift away from hospitals.
Exactly. So consider a long position in BrightSpring again, but this time, maybe hedge it by shorting a basket of traditional hospital operators.
Okay, betting against the old model.
Sort of. The thesis is that the shift toward home healthcare and these value-based payment models will disproportionately benefit companies structured like BrightSpring, offering that compelling alternative to facility-based care, potentially putting pressure on hospital volumes or margins over time.
Another interesting angle, betting on the decentralization of care, essentially.
You could put it that way, yeah.
Okay, 2 provocative ideas there. As always, folks, remember this is purely for discussion, for informational purposes, definitely not a financial advice. Please do your own homework, your own research before considering any trades.
Absolutely critical.
So that was our deep dive into BrightSpring Health Services' latest earnings. Strong numbers, clear drivers, interesting strategic moves. What stood out most to you? Let us know your thoughts. Thanks for tuning in to TalkTickers.